The broadcast is now starting.
Hello, traders. It is Thursday, the 20th of December, 2018. We're approaching the end of the year. I want to start off by saying, wishing you the greatest in 2019 and happy holidays, Merry Christmas, Happy Hanukkah, whatever it is you celebrate. Wishing you all the best. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Today, we're talking about a big topic. We're going to be here for a little bit. This is going to go longer than our other webinars because there's a lot to cover here. And this one can go for 5 hours. I'm not kidding. But we're going to keep this to about 45 minutes, and then we'll take about 15 minutes of questions. Yoda's here to keep an eye on time, also to answer as much as possible, just to take the load off of me. But also he will be interrupting me, and you know he's really good at rudely interrupting. So he'll be interrupting me throughout when there's a question that needs to be addressed in the moment. So just expect that as we go along. The topic, setting up for trading success in the new year. So here's what we're covering today. What is our goal for setting up for trading success? Like, why are we doing this? Why should this be a ritual that you do around the time of the holidays every year? It's really imperative of you as a trader to do this. So we'll go over the reasons why this should happen. It should be a calendar reminder to set you up for, hey, I need to spend maybe half a day going through this. And it does take a while. It's almost like for anybody that's worked in management or upper management in a corporation, this is almost like your strategic retreat where you take your top managers out to a resort and you spend the whole weekend locked up looking at each division, each department within each division, and having everybody come up with their cost projections, budgets, revenue projections, human resource projections, all that stuff. That's what we're doing here. That's what we want to do here, but at a much more, of course, a much lower level. Why? Because we need to come into the year with real clear objectives, because 2019 only happens once. Okay. Well, we'll be talking about identifying where we are currently. What methods do we use to figure out where we are on the roadmap in terms of performance, mindset, stages of competence, all that stuff. The next thing would be to set up performance and personal goals based on what we've learned from the top two steps, considering proper account sizing, because that's a really key piece to coming into trading into the new year. Are you underfunded? Are you using your funds efficiently? Choosing our services properly. We'll talk about what you should expect from your broker, your clearing firm, all that stuff, service providers. So we'll discuss some key things that we would be looking for just to help you through that process. This is not for any specific broker, by the way. This isn't to talk up any specific broker. We're completely broker agnostic. And this applies to all brokers alike, okay? And then we'll discuss what is and isn't important in terms of tools and equipment, things that you're spending money on, and then finally setting realistic expectations. We want to finish up by talking about what is realistic, really, and what is kind of pie in the sky type of daydreaming that we may be falling victim to as we come into the new year. Like, why are you here? Why are you wasting your time if you don't have goals, right? So this is the grand thing that we're going to talk about. What is our goal for setting up for trading success? The top goal, of course, is to identify those elements that will be most impactful in helping us towards success in the new year. In other words, we want to look at what are the pieces that we have to focus on. So that's a key imperative of what we're doing here is this exercise, as part of this exercise that I really strongly suggest everybody does. You're kind of you're setting yourself up for failure if you don't take at least an hour or whatever, you know, on a back of a napkin or something, anything, to set a plan and to set some goals and to set yourself up for what am I going after this year. So the top goal is to identify what elements will be most impactful in helping us towards our success this year. What are those things? What key things do we need to identify? In other words, time is limited, right? So we can come into money, we can lose money, we can win the lottery, we can lose that money too. All time just slushes in and out of our lives all the time. Everybody's experienced this. And the key thing is that money slushes in and out of our lives all the time. Time is a limited resource. We only have so many minutes of life. And so as we spend them on whatever we spend them, um, we need to make them count. And in trading, how can we make sure that we indulge as much as possible in things that aren't time suckers? So a lot of times traders will spend hours organizing a chart, hours selecting colors and backgrounds and figuring out the gradient, figuring out what color their candlesticks should be. I've seen my own traders do this. Just spend all this time. I've done it. I do it every once in a while still, but it's just not very productive. It is not an element that will be most impactful in helping us towards our success. Yeah, it's nice to have your chart set up the way you want, but let's not spend time on things that really aren't hitting helping us hit the bottom line, hit our goals. Are we aware of our progress toward our goals throughout the year? What systems or process do you have in place to measure the goals that you've set versus where you are, right? So as we go along in the year, we may have a spreadsheet that we put together. It's got some projections. I actually had examples for you, but I ran out of time. I'll try to put that together. Probably need a follow-up talk about this 6 months into the year to see where everybody is. Um, but I would create a projection for what I would like to see. It is kind of a dream board type of thing. We're just putting our energy out there in the universe, with our idea of what we want, so that hopefully we can uh, get either motivated and energized for it, or at least know in the back of our minds that this doesn't support my goal, or my goals are changing and I need to go back and change what that is. But how are we going to track our progress against our goals? This is something that goes into the plan. So our goal is to XYZ. My expectancy should be blah blah blah, and I want it to be XYZ whatever, or I'd like it to be, or whatever words you want to use. And then we look at, okay, January's over. What have I done versus what I expected or wanted to do? Okay, what adjustments do I need to do at the end of January for February in order to get closer? Do I need to adjust my goal down or adjust it up? My goal is not aggressive. Things like that. What elements will help us move forward with what we must do and will help maintain our dedication to the process? So this is the part where we talk about grit. Grit is a key part of trading. Without grit, there really isn't going to be longevity. That's why this business, whether it's stocks, Forex, options, futures, doesn't matter, CFDs, whatever. You see people just sloshing in, then going back to their job, and then feeling motivated again and coming back in and just in and out and in and out. And it's almost like walking in and out of a casino. What we want is to focus on the elements that will help us move forward and keep us motivated and dedicated to the process. The process. This is key. Let's highlight it. Let's underline it, bold it. We want to be dedicated to the process. Okay. So the next step, identifying where we are currently. So every single one of us should be keeping two pieces at least of two pieces of information at least on our trading. And some people combine this. You'll hear about this in the interview I did yesterday that'll be released by Futures Radio Show at the beginning of the year. But most people talk about journaling, and all of a sudden, people get glassy-eyed and they get sleepy, and they don't want to talk about journaling, kind of like talking about risk. But there are two components here. What most people call a journal, what a lot of people call a journal, and I've been sent many over the last 10 years, it's really more a diary. It's more of it's a process of just vetting out our thoughts and all that. And that's useful too. However, if you want to use your time the best you can and do the most impactful thing that you can, you need two components. You need a trading log. And a trading log is simply a tally of all of your trades, the details of them. And in this tally of all of our trades, we want to, hang on, I'm going to share this with you real quick. I need to eliminate the account number because this is a live account. All right. I'm sorry. This should have been done beforehand, but I'm not very organized today. I just want to share a trade log, okay, for real trades. So this would be considered a trade log. Some people look at this as a trade journal. This is not. It's a trade log. A trade log simply creates a record of all of your trades. You can have this by exporting it from your trading platform. Most trading platforms allow you to print it or export it to Excel or whatever, and it'll just list out what the trades were. This has a lot more detail. It's a custom app, but something simple that says what the product is, give each trade a number, what the product is, buy or sell, the quantity, did it win or lose, what time entered, time closed, and so on. And then we want to get to these, at a minimum, we want to get to these metrics right here. We want to get to a win percent, loss percent, average size winner. So the first winner is 112. So that's the average. And you can see as these winners kind of come along, if there are winners right here, 452, averaged with 112, 282. So this only changes when there's actually a winner in here. We want to track that so we can come up with this figure called expectancy or expected value in statistics. This over a large sample tells us how many dollars, and this is in dollars, including commissions for this particular gentleman. It tells us on a large sample, and this is not a large sample, how much we expect to win or lose based on past performance for each time this person trades. Right now, we expect to lose about $128. Okay, so that's a minimum figure that you would want to come up with. But I would suggest avoiding dollars. I have to show you dollars because regulations require me to show you performance in terms of all prices and all costs included. But for me, for myself, for my traders, and for you, I would suggest looking at ticks, looking at things in terms of ticks, and ticks per trade, and instead of ticks per contract. And so you end up with a trade log. Now, a trade log is a simple thing to do. You really should already be keeping one. And a trade log also helps you balance your statement. I'm sure all of you are just taking their monthly statements from your broker at the end of the month, from your clearing firm at the end of the month, and just balancing it out to make sure that you actually got the trades that you're supposed to and the costs that you're supposed to. I'm sure everybody's doing it here. But it helps with that too, if necessary. but it gives us some really important metrics, right? It tells us how much was traded on each trade. I can go into each trade and look at how much was traded. I have a running total of the trades completed versus the number of contracts traded, and so on and so forth. It creates this idea of what we're doing in terms of performance. But here's the important part. These are numbered. The second part of this, so once you know these are the performance metrics, the second part of this is the trade journal part. The trade journal has a couple of key purposes. The trade journal should correlate each journal entry, and this could be done on a spreadsheet, Evernote, OneNote, whatever you want. The trade journal correlates an entry with each trade that's been taken. Okay, so for every trade that has taken place, we would have a journal entry. And ideally, you're doing this with, as soon as you close a trade, it creates a sort of a, if it's a loss or a win, it doesn't matter. It's more helpful to take a break after a loss, but after each trade, you close out the trade. And the key things you want to take out of your journal is to check the box or uncheck it or grade yourself for performance. Have you followed your plan on this trade? How would you grade your performance on a 1 to 5 star basis? 5 star being great. So you need to grade every trade. And then the next column over, you need to, if the trade is not perfect, you need to state what it is that needs to be worked on. What is the error? Identify the error that you have introduced into this trade. And then what we're going to do is track those errors and the cost of those errors. And then the third part of the journal is it tracks if you have clearly identified setups, and you can name them whatever you want. It could be WhenFRG2 or whatever. If you can identify what it is you're trading, and if you're just trading scalps off of order flow, you can identify long from short at a minimum, right? You can identify, you can call it, order flow long, OFL, OFS, whatever it is, just to separate to separate your journal as much as possible, because that's going to come into effect and become very important later. If you don't keep a journal, you don't have any idea what you need to focus on, what your problems are, and the first thing you need to do, the key thing you need to do, is focus on your errors. Your errors are what cost you money and eat your lunch all day, every day. And if you don't know what your errors are, then you don't have a plan, and you need to step back even further and describe what it is you want to do. A trading plan is not an algo plan. It's not like if then else, and it's got 1,600 lines of code. That's not a trading plan. That could be a trading plan for a black box or a gray box type of system. It's fine. But for discretionary trading, it really is as simple as determine opening type. If opening type is such and such, will not trade short from this side. Look for pullbacks on impulse, against fibs, against key areas, whatever you want. Just think of a trading plan like you're sitting your spouse, wife, girlfriend, boyfriend, whatever, somebody significant, mom, dad, you're sitting them next to you, and you're describing to them what you're doing, what you're going to do on the day, how you trade. And they are patiently listening, and they're very interested in what you're going to say, and they understand all the terminology. All you're doing is passing on what that plan is. So think, what would you tell them with regards to how you're trading? And whatever nomenclature, whatever terminology you want to use, it doesn't matter, because it's really you who's going to read it. But what you're doing is you're describing your process. Write that down, and then try to identify within that what those trades are called. Okay. So the journal then helps you figure out what is the consistent error, what are the setups or the trade types that are costing money, what trade types pay you the most. Your trade performance log also helps you, which can then go into the journal, helps you determine when you're most profitable, when you're not. Should you avoid the first 15 minutes? Does anybody here know if they're profitable in the first half hour trading or not? Does anybody know? I don't know. I don't know. There are tools that tell you if that give you that information. The S5 Trade Analyzer, I don't know if Edgewonk does or others, but that's important to know. If you're not making money at a time of day, boy, how would that impact your results over a year to avoid that time of day or to plan for it, to just create a trading plan that takes that into account. The other thing we want to identify where we are currently in is our personal choices. You have your trading edge, and then you have your personal edge. Okay. Your personal edge is the quality of person and the quality of health that you bring. So the best example of this is anything that has performance tied to equipment versus man, versus human beings, mankind, right? So it's race car driving is an example, or somebody who flies, right? A fighter pilot. The machine has certain characteristics, just as your trading plan does. The airplane is unable or fails to do certain things. It's not designed for that. As your trading plan is not designed for a specific thing in the market that you may be trying to do here and there. But then there's the pilot, you. The pilot needs to be in tip-top shape as much as possible. How many of us out here are working out on a regular basis, have good blood work, all that stuff? Do you need to be a Top Gun to trade? You don't. You don't. But your ability to focus, the noise in your head, the quality of your attention span, the way you manage your feelings, the way you manage adversity, all of that hinges upon your personal edge. How healthy are you? How much can you take? What is going on in your life? Are you doing something about the things that you can control? You're going through some family upheaval, and your mom is driving your dad crazy, and they may get divorced, and blah blah blah. If there isn't something you can do about that, you want to do whatever you can to attain silence, to keep that out of your trading. Yes, it's an important thing in your life, but what you bring to the table is who you are. So this is the time to kind of put that together and decide for yourself what areas of your life are supporting your ability to trade. Yes, there's more to life than trading, but you're spending the time to do this. You must, it is necessary to give this some attention. What are you doing for yourself to improve your ability to have clarity, to have quiet in your head, your ability to manage and deal with stress? These are all tied to your life choices, your environment, your health choices, your food choices, things like that. Just make it a great year in 2019. Make it the year of change. What resources are available for trading still for next year? Have you blown through, 22,000 of a $25,000 account? Are those the resources that you have remaining? Take stock of that. How much time can you still devote to this process before others who are depending on you or your bills force you to go and be realistic about getting a job? We're in an economy that has been very, very hot. It's likely to slow down over the next year or two. Is this a good time to go find a job before things dry up? I don't know. I don't know the answers. You have to look at your situation, but do you have the time to fully commit and focus on what goes on with this process? Now, it doesn't mean you quit your job and you have to commit 100% of your time and resources. You can still come up with a plan where you are looking at the markets at certain times of the day and then doing your job at other times in the day and having a personal life at other times of the day. Okay. So these are where we identify where we are. This is kind of like the auction theory thing where we say, what has the market done? How good of a job, right? The next step is setting up performance and personal goals based on current metrics. So once you've identified and just written down where you are with these things, and the list can go on and on and on, the next thing is you want to know, it's really important to know what areas are you strong in. So as a trader, what are the things that are paying? What things are you doing that are paying you off? Again, your trade log will give you that. Your journal will provide color to help you identify those areas. It's really important to know your strengths, because in trading, you want to press your strengths. You know, if you're good in high volatility, you have been busy for the last 2 months. This you could make your entire year in a couple of weeks in the last 2 months. But if your strength is, you know, trading balance in a tight range, and that's what you need, and every time you've tried to trade a thinner product that is more trending or more volatile, you end up getting yourself in trouble. Understanding your strength means you probably should conserve your capital and just move to sim or do something else while the market's doing its thing, or find products that are more liquid. Go trade euro dollars or something. Use short dated treasuries that have a lot of liquidity in them. Choose something in Europe or whatever that matches your strength. So it's really important to identify that strength and then play off of it. Which performance metrics can we impact with this strength? So if we know that we do well, so let me show you this. So here's this same gentleman. So I selected one contract. I looked at the last 3 months. I selected one contract, but there are many here. This person's in a lot of products, right? So what this person can do is they can look at their performance in each product, each type of product, right? So expectancy for the Australian is not so good. Expectancy in this, what is this, cocoa, horrible, right? Then we go to ES. We look for what happens there. Expectancy is positive, $264 per contract. This is their P&L over the last 3 months. This is actual live performance. I don't know this person. Okay, so we know we have some strength in the ES. We know that 6A costs us money. We know that cocoa costs us money. Crude. And this is part of your taking stock, your trade log, analyzing your trade log and coming up with the conclusions. Crude, flat after costs. So not really doing anything in there. Gold. Again, I'm not going to go through this person's entire record, but this is what I was referring to. Gold does really well. That's his strongest product. Okay, his or hers. I don't know who they are. So once we identify those products that are costing us money and the products that make money, let's not trade the products that cost us money. Unless you know what it is about the product that is costing money, that is creating these losses, time of day, the volatility is too high, it's trending, and you tend to be a mean reversion trader, whatever. Unless you identify the specifics, stay out. Just stay out. It's not worth it. It's not worth your time. So this is part of the goal setting for 2019. If you're strong trading gold, but are horrible with equity indices, well, guess what? Gold becomes your market. Now you've narrowed down your attention to gold. You can spend more time on it. You can look at the macro side of gold or the fundamental side of gold, learn the product and become a master at it even more in 2019 to extract more money out of it. This becomes your tool, your thing that you're an expert in. If our performance has been mediocre, then what areas can we focus on improving to see results? Is our win percent low given our average win? Is our, do we need to focus on letting winners run? Do we have full stop outs more often than we should? Right? So when we look at this person's metrics, we go to the bottom of this in gold. They stop out 9% of the time. They've stopped out 9% of the time. That's a full stop out, no BSO. Now this person's trading one lots in here, so there's no BSO, but that's something you can extract from your trading log as well. And if it's not in there, it's something you need to start tracking, or you can go back in time and build the record for it. You can see I got in here, it went to this, and then I got stopped out, didn't get any scale outs, blah, blah, blah. So if that's an area that needs improvement, then that's an area that needs improvement. It's a surgical thing that we're after here. We're after some really imagine if you were a tennis player and you had let's say a professional golfer. If you're a professional golfer, you probably have a coach and you probably have a manager of some sort, and their job is to track your performance, track which courses you're good in, that you do well in, track which environments are bad for you, and so on. And then what are they going to do once they figure out what your strengths are, what tournaments you do well in, what areas of the country or the planet, what kind of lies, what kind of golf courses are difficult for you or that you do well in. What do you think their next step is to do their job? What do you think they'll do next? Anybody? Are you all asleep? Yeah. What will they do? They're going to
Focus on the ones they play well.
exactly. They're going to focus on your strengths, and that's this part of the exercise. You're going to press your strengths. You're going to press your advantage, and that's your edge. Okay? And then on top of that, once you've figured out what that is, the next step is to figure out if the market's able to yield the goals that you want. Right? So it's great to say, well, I've been pulling 6 points on my trades, my one lot trades all year. That's really what's paid off. That's really what's paid off. Next year, I'm going to double that. I'm going to go to 12 points per trade. But if you're in a market that only yields 9 points, it's not going to work. So you need to look at what kind of market are you in? Are you in the right product, and so on? These take time. So let's look at account sizing. So account sizing, the equity that you're trading, is a key determinant of your ability to succeed, and it has to do with the risk of ruin. So somebody comes to me and says, I'm trading the ES with $2,500. Okay. Unless they have a lot of experience, and by experience, I don't mean 10,000 hours. That's nonsense. I'm talking about the number of trades they've taken and live trades that they've taken and have managed. Unless they have a huge number of trades, I would say that this person is doomed to either pick a lot of small trades and kind of bleed through costs, platform costs, commissions, things like that, because that represents a high percent of their account at $3,000. Or they're going to get to a point where they're likely to say, and I've seen this so many times, it's $3,000. I am sick of this. I'm sick of the market always taking my money away from me. I'm just not going to get out of this trade. And then they watch their account go from $3,000 to $500 before their broker blows them out. The risk of ruin is really directly correlated to the account size. So it's really important, as it is in betting on poker or anything. Really, it's really important to start with a good size capital for what you want to do. And a good size capital is a function of what product you're going to trade, the amount of risk per trade you're going to take, amount of room that you need to take, the margin requirement of that product, time of day, all these things. So let's look at risk of ruin. Risk of ruin is directly correlated with the amount we risk per trade. So the risk of ruin on one trade, let's say you take one trade and you're betting your whole account. Your risk of ruin is 50%. The outcome that's going to cause you to lose your entire account is the loss, and that outcome is 50% of the potential outcomes. So one trade at 50% are ruin. Smaller account sizes have a risk of blowing out, have a higher risk of blowing out. So that's one. Doesn't mean you cannot trade with a small account. You just have to make some adjustments. Consider full margin per contract. That's the baseline. So we want to trade full margin per contract if we can. Okay. It gives you room to take losses. It gives you room to really see if your edge is going to show up. You're likely, as long as you don't risk, 10% per trade, you're likely to see a few hundred trades with some significant portion of those being losses for an account that has full margin to actually wipe out. That's not to account for cost, which we'll discuss in a second. Aggressive account sizing would be 50%. Go ahead.
You want to just define what you mean by full margin for those that don't know?
Very cool. Good question. It's the very next slide. It probably should interrupt the slide somewhere, but it is the very next slide. I'll go over what full margin means and how we compute that, where we get it from. So to be aggressive, if you're going to be on the aggressive side and you have this as risk capital, remember we're trading a leverage product in futures and options. That's why it's not suitable for everyone. If you're going to be extra aggressive, the maximum leverage you should give yourself to avoid ruin is 50% of the exchange margin. 50%. Okay. So $500 margins represent, what is it? 8%. I think AMP even takes $400 margins on the ES. $400 margins represent just 6% of the exchange margin. And you know what that represents given current prices at 2,500 $400 margins at current prices represent 0.32%. It's an insane amount of leverage. You are more likely than not going to bust out. So if you're going to be aggressive, be at 50% maximum. Okay. Let's look at margins. Margins are simply the amount of deposit that the exchange requires of everybody equally. It's the amount of deposit that the exchange requires on hand to trade each contract. The margin is calculated on a statistical study that the exchange runs all the time that encompasses, I think, a 4 standard deviation move per contract on any given session. So currently the full margin on the ES is $6,600, $6,600. If you want to see what those margins are for yourself or go find them and you don't want to rely on a clearing firm or broker's website, you can go to go2ct.pro/CME margins, case sensitive, and that'll take you directly into the CME's margin table. And then from there, you can select the product, the exchange, the product, and so on. And what that'll give you is the maintenance margin. Maintenance margin is how much you're required to keep in your account to hold a position that you initiated previously. So if I initiate an ES contract today and I hold it through the close, I have to have $600. But the next day, if I maintain that contract, if I hold that contract, the next day's close.
6,000.
I mean, 6,000. No, it's $6,600 to initiate.
Yes, but you said to hold it overnight, you need 600. You need 6,000 to hold it overnight.
It should be 6,600 on that day. on the
Okay, but
initial day.
I'm just clarifying because you said to hold it overnight you need 600.
Oh, it should be 6,600. I said 600. Okay, I'm sorry about that. So 6,600 on the first day. On ensuing days, you need to keep maintenance margin $6,000. The exchange is giving you about 10% fluctuation there, to hold that position. So that's full margin, okay, that per contract. And many of you are familiar with the $500 margins and so on. This is really what you should be funding with to trade whatever product. And you can see based on the product, the margin changes. On the NQ, it's 7,700. It's been very volatile. The RTY, 3,900. You look at the DAX, 23,395 euros. Very, very risky product. So let's say you don't have the capital. So what I would suggest is go look at these products. Look at the color them here. Look at the M6E, MGC, these kind of micro products. There are also some things coming out next year that we'll discuss and we'll be parading as they become available to make it easier to trade with a smaller account size. So you don't have to go and trade SPY or CFDs or whatever, so that you're trading on a regulated exchange. But you should look to learn on the smaller products. You can see that the M6E is only 1/10 of the 6E because it's 1/10 in size. And so this information is readily available on many, every exchange publicly shares this information. Base your decisions on this in terms of funding. 50% intraday is the maximum leverage you should use for anybody who reasonably wants to be around and learn to trade. Let's move on. Are there any questions regarding that? I think margins confuse people a lot. Do we have any?
No, I've been answering one. Some people have pointed out that different brokers have different margins, and the margins can be set by each broker, but the maintenance margin, which is the overnight margin, has to be at least the amount that's set by the CME. So in that case, $6,000 for the ES.
Right, whatever the exchange happens to be. Yes,
Yes.
exactly. You should know what that is, by the way. Don't trade a product without knowing its margin. Its margin is your first indication of how risky that product is from the people who created it. So it's really important information. Let's now talk about choosing our services. And the first thing I want to talk about is brokerage. So the way the futures industry is structured is that versus stocks, we don't have ECNs and we don't have different pathways to the exchange and so on. We have specific exchanges. The CME bought up, and owns 4 exchanges: the CME, COMEX, NYMEX, and CBOT, and each one of those has different products. Then there's Eurex, which is next in line. Then there's ICE, and so on and so forth. And it just goes on, and they're global exchanges all over the place. The exchange, in order to give access to the public, it cannot do so directly. Think of the exchange almost like General Motors or Mercedes. Mercedes does not open its factory doors to the consumer. It doesn't do that. What it does is it sells to dealers. It sells to distributors and dealers. And those distributors and dealers in the futures universe are called clearing firms or futures commission merchants, FCMs. FCMs are companies like RJ O'Brien, ABN AMRO, Gain Capital, Dorman, AMP, Iron Beam, I think, uses others, Advantage Futures, and so on and so forth. These are companies that have put up millions of dollars to guarantee the trades held by their customers. So they have their own margin requirement that is kind of universal. And then the exchange gives them the right to be able to give access to their customers into the exchange. So when you're trading futures, you're not trading against your clearing firm. You're not trading against your broker. Your trades, you're not even trading against the exchange. The exchange is just behaving as a medium to make markets, period. Kind of like eBay. eBay doesn't bid up that, new laptop you're trying to buy. They don't share your bid, your best bid on the auction on eBay. They're just there facilitating and guaranteeing that you'll get what they say, what the seller says. And it controls and manages and does compliance on the sellers and the buyers. That's what the exchange does. It controls and manages the clearing firms. The clearing firms can sell to the public directly, but most clearing firms sell their services to brokerages. So that's when you have these independent introducing brokers, IIBs, or guaranteed introducing brokers, and so on. I won't get into too much detail there, but when you talk about a broker, you're talking about an entity that has a clearing firm behind it. The clearing firm is the party responsible for holding your money. That's where your money goes. Your broker does not hold your money. Okay? It's the clearing firm that does. The clearing firm is required to keep your money in a segregated account in futures. It cannot use your funds to bridge its expenses. That would be illegal. It cannot use your funds to do anything with except to hold them and to debit or credit them based on your trades, period. Okay. And if anything goes wrong, your clearing firm's on the hook with the exchange. So if I went and bought 1,000 contracts yesterday and I cleared those trades through my clearing firm, and you happen to, 50 people happen to be on the opposite side of that trade, and you made a lot of money, and then I just put my arms up and I said, I'm moving to Guatemala and I'm not paying the $2 million or $3 million I lost. It's the clearing firm that has to pay that. The clearing firm has to reach into its pockets and put up the money so that each person that has held the opposing position against me, who I bought from, or who sold me the contracts, are made whole. This is why futures don't have SIPC. We don't have insurance, never been needed. Futures have had many instances of blowups, REFCO, IMF Global, PFG, and so on. But ultimately, the exchange and other clearers step in to make the customers whole, and there is no fee for insurance, and there is no insurance. Okay. Now, your broker is just somebody who introduces you to the clearing firm and manages your needs, because the clearing firm does not want or doesn't have the staff to handle your business. So the broker comes in and offers that service, and they collect a commission. They share it. They don't collect their own commission. They're simply sharing the commission with the clearing firm that the clearing firm collects from your account. So every time you click, you might have a commission, a total cost of, say, $4. A small portion of that ends up with your clearing firm and your broker. The rest goes to the exchange, depending on your member status, and so on and so forth. Is everybody clear on where your broker sits versus your clearing firm versus the exchange? I want to make that clear because there's a lot of confusion when it comes to how the futures industry is structured.
Yeah, great explanation is the comment coming back, and you have 8 minutes to wrap up.
All right. Your commissions don't actually go to the broker. Your commissions get paid, as I said, to your clearing firm, and your commission includes, when you say the word commission, it actually includes clearing fees, Globex fees, it includes NFA fees, regulatory government fees, and it includes then a portion that goes to your clearing firm and a portion that goes to your broker. So on a $5 ES commission, there's I believe it's $2.32 that go right to the exchange. So about 50% of that goes to the exchange. Then you have the regulatory fee of about 4 cents, I think, and then the rest ends up with the clearing firm. The clearing firm then has to pay the broker whatever portion is theirs, and then the rest goes into running their business, paying their staff, paying for systems, and so on and so forth. So that's how commissions work. So when you go to your broker and you ask for lower commissions, they can only control a small portion of that, some portion of it, depending on their deal with the clearing firm. Okay, just I want you to understand that most clearing statements, when you look at your statement, should list how much is going to the exchange, how much is NFA or regulatory, depending on the product and where you are, and how much is going into your broker, which all includes your clearing firm. And then there are also transaction fees. So if you use certain software, there's a transaction fee for using that software, like CQG or Rhythmic or iBroker or something like that. There's a transaction cost that's also added to your bill. What costs can you reduce as a trader? With volume. As your volume increases, you can actually go and consider becoming an exchange member, or at least leasing a seat. That can automatically reduce your cost about $1. I think it's $1 per side, $2 per round trip for becoming a lease member. I'm an exchange member. I've owned my seat for a long time. It's more than that. So I get a much lower price point. But the only time this makes sense is if you trade enough. So generally, the break point, I haven't calculated it recently, but the costs of membership have come down dramatically. Generally, the break-even point somewhere around 40 sides a day minimum on a consistent basis. There are also other programs that you can look up in the exchange, things like electronic clearing memberships, incentive programs. If they're trying to get more volume out of Asia, if you're based out of Asia trading CME products, they may give you a rebate, things like that. So those are areas that you can reduce your cost in. And then, of course, you can always go to your broker and ask. Choosing or changing brokers because you're getting 5 cents less at XYZ versus ABC is usually not a wise choice. You want to make sure that you do get through to your broker easily, to a person easily, and most importantly to me personally, is that your broker has many clearing relationships so that they don't just clear one place. If you have a problem with one platform and that's the only platform that your clearer or broker handles, you're kind of screwed. You have to go open an account somewhere else. My preference is to go with a broker that can quickly put me on a different platform here, there, everywhere. You know, if Rhythmic's not working out for me, I might go to CQG. CQG doesn't work for me, I might go to CTS or XTrader or whatever, Gain. Or so that's an important factor. And a broker's not is really clear. It's really clear what the broker thinks of you when things don't go well. When they're getting 50 calls a second because a platform went down, are they handling their internal systems and traders, or are they only clearing trades for the outside, for customers? Some clearing firms have their internal operations, and resources are going to go to that because their money's in the market as well. I don't go to those. I prefer to go to someone who's only there to support external clients. And always, because your money's sitting with a clearing firm, always check on a periodic basis, check what your clearing firm's equity is. There's this website you can go to. It's a regulatory site called the CFTC's FCM. I think it's the FCM's condition report or something like that. But we linked it right here. Go to CT.pro FCM data, and you can look at your FCM, and it'll show how much equity they have. And it'll show how big they are. You can download the spreadsheet and just look at all the clearing firms. These are the people that are holding your money. You want to make sure that you're dealing with someone that's got a fair amount of margin capital, is well capitalized. When should you take your business elsewhere when it comes to services? Take your business elsewhere not because of cost always. You can always talk to your broker about reducing your cost, but take your business elsewhere when you're just not getting treated right just because you don't trade enough, or you're not getting the response that you need, or your options are limited in terms of technology and solutions. Okay. Again, I'm telling you this agnostically. I am not interested in recommending any particular broker, but these are things you want to consider in your business for next year. Moving on, let's make this quick here. What is and isn't important in terms of tools and equipment? I follow these simple rules. I've always followed these simple rules. The data, I don't mess with my data. It's hard enough to trade. I have to trust my data. So if it's not accurate, I don't care about it. I don't want it. It doesn't matter. I'm not going to run a business on data that is choppy or is poor or is inaccurate. Tools must be easy to maintain once we learn them. We all have to go through the process of learning something. So if you're learning IRT, which is difficult to learn, Sierra or whatever, we have to go through that process. We have to give that tool the time it needs for you to learn it. You're learning a new piece of equipment or software, you need to be patient. However, it must be easy to maintain. I can't be dealing with tech issues all the time. A vendor will lose me very, very quickly if I have to sit here and deal with them and they're trying to help me all the time. I don't want it. Just drop it, move on. There are too many competitors out there for you to mess with that. Your time is not well spent. If it helps us know what may drive the market, then we want it. So if I'm trading stocks and there's a publication that helps me understand the fundamentals more easily because I can't just go through all their filings, then that's something I want to use to make those decisions. News has always been a staple for trading. To me, news is as important to me as my mouse or keyboard. It's like I need to know in general. I need somebody to distill for me what's going on out there because I don't have the time to go through the headlines. So to me, that's worth it, and that's why we added it as a standard feature for everyone at Convergent. If it doesn't support our execution process, then we don't want it. If you're paying for stuff that you don't use and isn't helping you decide on the next trade, get rid of it. Get rid of it. You like it, you like the vendor, you like this, just get rid of it. Cut your costs. If it's not helping you make decisions in terms of execution, it isn't worth the money. Finally, I know the time is up. Setting realistic expectations. What will be expected under a focused prop environment where risk is managed, growth is managed, emphasis on sizing up. What would I expect for next year? The key thing I expect, and the key thing we should all expect of ourselves, is that we're improving in terms of process, we're improving in terms of execution, and the best way to get to that is by eliminating errors, understanding ourselves and understanding our errors and eliminating them. A prop trader has about 9 months to show promise and $25,000 at risk, and then it's over. So if they're sitting there and they're continuing to decline and they're still not trading and they're still simulating and they're still, dealing with the same issues, bringing up every meeting, bringing up the same issue. Oh, I took it and then I scratched it and then the market did this and this time I saved money, but last time it made money. If that's the conversation, they're gone. There's just no time to keep repeating the same stuff. We also don't want to get a trader to be too comfortable in their current size. It's really important for traders to size up because we're here to multiply returns and we're here to push our edge, push our strength. So the thing we want to do is constantly push ourselves to do more, to do better. Now, don't go too quickly because you have to earn the margin for the next contract. That's the thing that controls it. But I wouldn't get comfortable with a 2-lot. Yeah, I'm making, $500 a day, trading 2 contracts. I'm happy with that, day in, day out, month in, month out. I'm good. No, I'm looking to go to 3 and I'm looking to go to 4 because your edge is being blunted by the market over time. So you want to press that edge as quickly as you can in a risk sensitive and intelligent way. You always want to press your edge because it gets blunted over time. The market changes. We're constantly adapting. Given our personal circumstances, job, family, health, we are able to dedicate the time needed to do. Are we able to dedicate the time needed to do the work? So set expectations here. Make it clear to those who depend on you what your availability is going to be. Make it known when you need quiet time, what resources you need, how much time you need. Make them not the problem for next year. Also, it's unrealistic to set dollar expectations. So it's unrealistic to assume that we can leave our job and sustain ourselves because we think we can turn $5,000 into $50,000. Now, this is a leveraged product. And like we did with Kevin last week, K Cho, on that intervention, we saw that he ran up, what is it, $25,000 in 20 days. That happens in futures. It happens a fair amount in my experience. However, long term, you still get the same. You'll still want this. You'll get the same returns as any other investor. We're using leverage, and that leverage can hurt us during bad times. So just as we may run up $25,000 in 20 days, we may lose $10,000 in 6 days of hitting our daily loss limit. But the overall return is not going to be, in this case, $5,000 to $50,000 a year, 1,000% return. It isn't going to happen that way. Okay, so be realistic about what you should expect. Are the market regime, cycle, and time frame we're trading in support of this goal? In support of this goal, right? So if we are setting goals, we want to make sure that the market regime, the participants in there, the time frame we're in, are realistic for the goals that we've set. If volatility collapses, how does it impact next year's performance? What if it's too high for a very long time? How does it impact it then? But the bottom line to all of this is to create a plan. Really important to create some sort of a plan to help guide you, even if it's rudimentary, to help guide you into the next year. We can't determine success, but we can create more opportunities by having a plan that we then act on with confidence, no matter the outcome. So at the end of the day, you blow out, you can't trade anymore. You know that you gave this 150%, you gave it its due, and for that, you've become better at managing yourself, managing a business. You've seen how things work out. You have a better understanding of risk. You have a better understanding of the market, whatever. But you didn't make it. But you come in and you just kind of slosh around your account, trading randomly, gambling, and then having to go back to work. That's time and money lost with very little gained. That's all I have to say for you for this topic. I know I'm going way over time. Is there anything I didn't address?
No, I've addressed everything that's been asked.
Thank you, and thanks everyone who listened. Hopefully you've gained something today and you can apply this over the next couple weeks before the year turns over. Come into the next year with a plan. Let's make 2019 the best year ever. Take care.